Good evening once again and welcome back everyone. We now begin the next segment of the program. It is my pleasure to introduce our keynote speaker, Dr. Michael Devereux. Dr. Michael Devereux is a leading authority in business taxation and international tax policy. He is Emeritus Director of the Oxford University Centre for Business Taxation and Emeritus Professor at the Saïd Business School, University of Oxford, where he also serves as a Professional Fellow of Oriel College. Over a distinguished academic career, Professor Devereux has made seminal contributions to understanding how taxation influences corporate behavior, including investment, location decisions, and financial structures. His work has been particularly influential in shaping contemporary debates on international corporate taxation and tax competition. Beyond academia, he has played an important role in global tax policy. He has advised leading institutions, including the OECD, the European Commission, the IMF, and the UK government, and has contributed to high-level policy discussions on the reform of the international tax system, including the taxation of multilateral enterprises. Professor Devereux is also closely associated with several major research networks, including the Institute for Fiscal Studies, the Center for Economic Policy Research, and CESIPO. He has held prominent editorial positions in top journals such as International Tax and Public Finance and Fiscal Studies, and has served as president of International Institute of Public Finance. He holds a PhD in economics from University College London and has previously held senior academic positions at the universities of Warwick and Kiel. Today, Dr. Devereux will deliver his keynote titled, "Where Should International Profits Be Taxed?" I request Dr. Sachidanand Mukherjee, Professor, NIPFP, to kindly chair the session. Over to you, sir.
Thank you very much, Resham, and good evening to all of you. And it's my pleasure to invite Professor Michael Devereux to make his presentation. So, please.
Greetings. Thank you so much for inviting me. I'm honored to be here to help celebrate your golden celebrations. Lasting 50 years in a research institute like this is a big achievement. I'd like to congratulate you all on getting to that point. My own centre is about 20 years old, so we're at least 30 years behind. I would like to invite you all to our 50th anniversary in due course. So I thought I would talk about international taxes, and over the last few hours I've been thinking, perhaps do I need to justify why I want to talk about international taxes as opposed to all the other taxes you've got, the amount of money that's raised from it and so on. Then we have a brief attempt to do that before moving on. So I think there's two things that one, you might be thinking, perhaps you're here because you're all interested in international tax, perhaps you're here because it's the golden anniversary. But one could argue that international tax isn't so important for tax revenues. There's a lot more money raised from GST than there is from international taxes on corporate profit. You might also think it doesn't really matter what we think about international taxes because they'll never change anyway, because it requires multilateral consensus across pretty much the whole world, and that'll never happen. So why bother to think about it? I think I'd like to challenge both of those before I get very much further. The first challenge is that the distribution of economic activity in the private sector amongst companies is heavily skewed towards very large companies. It is in most countries. It is in my country. I believe it is in India as well. So looking at some statistics in preparation for this talk, the numbers that I found for India are that about 80% of exports from India derived from multinational companies, either Indian multinationals or foreign multinationals, and 80% of corporate income tax revenues come from similar kind of companies. So the way that we tax them is going to be pretty important for the economy of India. And in terms of will anything ever change, we've just been through the most radical change in the international tax system for 100 years. In the last 10 years or so, slightly over 10 years, the international consensus has been actually the system that we have doesn't work very well, and it needs reform. We went through the OECD's BEPS process, that's base erosion and profit shifting, between 2013 and 2015, where the collective wisdom of the countries involved at the time was we needed to effectively create more anti-avoidance legislation and put that into legislations around the world. And since that was a 2-year project, which was pretty radical at the time, but was not going to solve the problem. And I think everybody realized that. We then went into a much longer process of trying to developing more radical solutions, both in the OECD and what they set up as the inclusive framework, in which India was very much involved. So I think there is possible change. I think we've now gone through a process where we've introduced what I say there is now a global minimum tax, which some countries have implemented and others, including India, have not so far. So I want to kind of build on that, because I think, even having done that, we're a long way from a solution for the taxation of multinational companies generally, which will work well. And so what should we do? How do we think about reform? And my starting point is going to be that I don't think we should think about reform in the way that we normally think about tax reform, which is to say, let's take the existing system with all its complexities, think of tweaking it in different ways, like we did in the BEPS project, for example. We introduced very complicated anti-avoidance rules in the BEPS project to try and prevent profit shifting and tax avoidance. That kind of worked up to a bit, but in the end, we're still left with the same system, and the fundamental problems of that system still remain. So I'd like to not think about how can we tweak the existing system to make it a bit better. I like to take several steps back and say, let's pretend we're in the 1920s to start off with, and we're designing afresh. If we go back to first principles, what would be a good way of thinking about taxing multinational companies, the biggest companies in the world? Those multinationals are bigger than many countries themselves, maybe not bigger than India, but certainly bigger than many smaller countries. How can we tax them? Okay, and that could involve radical reform from where we are now. So that's kind of an interesting academic exercise, but is it academic in the worst sense of the word, in sense that, okay, we can talk about it, but it will never happen. So let me say towards the end, if I get that far, and I will try and say something about how it might happen, or possible ways forward. So that's the plan. And let's start with a question. What do the following taxes, proposed taxes, because they don't all exist, and tax features, because they're not all entire taxes themselves, what do they all have in common? They are not all new, but several of them are new. GSTs have been around in the world for a long time, but we're making great use of them. Sales taxes have been around for a long time. Tariffs have been around for even longer, but they've somewhat received something of a resurgence, at least in the United States. And we have an equalization levy for digital companies. The EU has a carbon border adjustment mechanism. The US has something called BEAT, which I won't try and explain now. Pillar 1 was part of the agreement in the OECD in 2021, and the UN is proposing withholding taxes on services. What do they all have in common? They're all levied in the market country. So all of those things, the tariffs, if I export to the US, they're going to put a tariff on me. If I export to India, they'll be subject to the GST, and we can go through all the others like that. Why are they all levied in the market country? Why is President Trump so keen on tariffs? Because actually, the US is a massive market. There's a lot of sales in America. If you're outside America and you want to sell to Americans, you have to export to America. That's the power of tariffs is, whether tariffs themselves are a good idea or not, it's certainly possible to levy taxes in that way. That American market is not going to go away because of tariffs. It's going to be there, and that gives an opportunity to tax those imports into the US. I would say President Trump has discovered the power of taxes levied in the market country. And all these other taxes are as well. And they're all of different forms, and some are better than others. I'm not advocating any of these particular forms of taxes. My point is actually there is a power to taxing in the market country because there's an immobility there. It's kind of mostly economists in the room, I believe. So we're thinking about the immobility of individual consumers. Now, it's true that people may move around, but on the whole, they're not going to move very, very much because of the fact that there's a tax on their consumption. Certainly not to the extent to which multinationals move other of their activities around, where they do their R&D, where they do their production. All of those things are much more mobile than consumers are. Okay, so remember that. That's my starting point. I'm going to come back to that in due course. But let's take a step back. I'd like to say, if we go back to what are possible rationales for taxing profit at all, does that give us some idea of where we should tax them? Okay, so the question of why tax profit at all, I don't really want to kind of ask that question. I want to say, if one of these is our rationale, does it kind of give us an indication to my main question which is where to tax it? I say, is it a proxy for personal income tax? So we want to tax the capital income of individuals in our country. We do that through taxes on interest receipts, through taxes on dividends and so on. Why do we tax companies? Arguably because there's some element of the profits made in companies which is not distributed out to the shareholders. We would like to tax that in the hands of the shareholders. It's not distributed. It's easier to tax it in the hands of the company, those retained earnings in the company, than it is to wait until it's distributed. But if that's the rationale, then I would say that existing corporation taxes are not doing a great job at doing that. If I have a business which is suppose I'm an owner of a business in India, the UK government wants to tax my income from that. Actually, the Indian corporation tax is not really helping the UK tax my personal income at all because it's levied in a different place. My income tax in the UK is levied on a residence basis on my worldwide income. Corporation taxes are typically levied more or less where profit is created, and I'll come back to that. So that doesn't really help very much. If that's the rationale, we should think of allocating the profits of the company back to where the shareholder is around the world somewhere else, and I would be taxed on that profit generated in India. That's certainly not what we do at the moment. A different rationale would be to say, okay, well, my business in India is receiving the benefits of publicly provided goods and services in India, should make a contribution to the cost of those. That would be a reasonable point. My question there is, well, is profit a good measure of the benefits that I receive from those public goods and services? I might be receiving huge benefit, but actually not making any profit at all. So I think that would be a justification for my business paying some taxes in India, but what the nature of those taxes are is quite different from thinking about a tax on profit. The third rationale could be actually it's a great way of taxing non-residents. If we take my example again, India may want to tax me because I'm not in India. I don't live here. I live in the UK. It'd be great if you can tax foreigners. If you can put the tax burden onto foreigners, that's got to be a vote winner, surely. And on the question there is, well, how would you do it? If you really want to tax foreigners, that's more like a tariff, really. And, if we want to do that, that's a kind of interesting question. Where does that tell us we want to tax profit? Well, it depends, the ways in which we could address that. It could be that I actually have, business activities here. It could be that I've got sales here. There are different ways that we could think about that. I think my fundamental answer to this question is, if we think about all those rationales for this tax in the first place, it doesn't really give us a very clear indication of where we should be taxing that profit. That's the point I want to make. So the next question is, if we don't have such a clear rationale, now how should we evaluate different options? Let's take the existing system. Think, does it perform well? Now, we should have some criteria for assessing whether it performs well. And here are my criteria. These are the ones. Adam Smith thought of most of these, so I'm not claiming originality for them. Fairness, definitely want it to be fair, although the nature of fairness in the context of international tax on profit, I think, is really difficult to figure out. And I won't get into too much detail, but I'm happy to talk about that later. Economic efficiency, agree. I'm an economist. I think this is really important as well. You know, we think there's an excess burden of taxation. I think the excess burden of taxation due to distortions on the taxes that distort the activities of multinational companies can really be very large. You know, if a company decides to go to India or to some other country, you know, that can have quite profound implications. And if lots of companies are doing that, you know, that has a big excess burden, a big economic efficiency. I think it's, you know, as an economist talking to policymakers, trying to sell that idea to policymakers, I've always found quite difficult. You know, they say, well, how big is it? You know, where is it measured? You know, where can we find it? Because, you know, how can I persuade the voters that the excess burden is important? Now, those things are, I think it's quite difficult to argue about with policymakers. If I'm in a room full of economists, I hope it's going to be a bit easier to that we can agree that this is important. Ease of administration, clearly important. You know, we have one of the most complex, you know, tax systems imaginable at the moment, except that, you know, it just gets more complex all the time. So, you know, our imagination has to run wild to imagine how much more difficult it could be to comply with the international tax system. I've literally heard it said in a UK context that multinationals are pretending to comply with the, you know, with the details of the tax law, and the tax authorities are pretending that they are complying with it because it's so difficult. Neither side really knows whether they're complying or not. And you only have to, you know, read some of the proposals coming out of the BEPS project to think, well, if anybody's read all of that and can explain it to me, I would be very grateful. And but it's extraordinarily difficult. And the thing which most countries and most governments have focused on over the last few years has been the next one, which is robustness to avoidance and profit shifting. So it's, you know, certainly the case that multinationals have found places to put their profits where they will not be taxed very lightly. And that's clearly a problem for revenue purposes. I should point out some of these criteria conflict with each other. You know, if it were the case that multinationals could costlessly shift all their profits to the Cayman Islands and pay no tax, you know, we're not going to collect very much revenue, so that's a problem. However, we're also going to have a purely, you know, an economically efficient tax because actually we're not collecting any tax. So if they can do it all costlessly, you know, that has some benefits for the size of the excess burden for the tax. And there's going to be a trade-off there. The more that we actually collect from multinational companies, the more likely it is that there are going to be distortions to their decisions, creating excess burdens. And the last one is reactions that I call reactions of other countries. I'm thinking of tax competition here. So if we want companies to invest in our country rather than somebody else's, you know, one way of trying to achieve that is to reduce our tax rate. And that's been a process which was happening over the last 40, 50 years. And corporation tax rates have been going down the world over in order, as a part of that tax competition process. I'll come on to where we think we are now with the global minimum tax and so on. And finally, you know, we should acknowledge there are at least two different ways of looking at this. One is we can take a global perspective. You know, we can make ourselves, you know, in charge of the United Nations and think from a global perspective, or we could think from an individual country perspective, or we may get different answers to these points. So let's just bear that in mind for the time being. So those are my criteria. I'm going to briefly evaluate the existing system on these criteria, briefly examine other possible systems under these criteria as well. And so for those of you who don't really know anything about the international tax system, I'm going to give you a kind of 1.5 minute summary, which is not going to be enough for you to advise any clients on how to move profits to the Cayman Islands. So the basics come from the 1920s and the League of Nations, and essentially it was a compromise. So they said, look, let's think of there's investors in country A and there's economic activity in country B. Both country A and country B have some claim to tax the profits that are made from those activities. And so let's have a compromise. We'll tax active income in the source country, that's country B, and we'll tax passive income in the residence country, that's country A. That's a great idea. Might seem like a good idea in the 1920s. If you kind of think about it for more than a few seconds, you think, well, let's try and define what we mean by source. Let's try and define what we mean by residence. Let's try and define what we mean by passive and active. And, in those 4 definitions, I think that goes to the heart of all the problems that we have in the existing tax system. And actually, so not long ago, I formed a committee of economists and lawyers. And actually, I was going to mention this, but we have got a book, which is the outcome of this, where we're trying to think about how should the international tax system be reformed. And, there were great economists, great lawyers on this. And we were talking about residence and source for, I would say, quite a long time, months, before we realized that actually what the economists meant by residence and source was just completely different from what the lawyers understood by the terms residence and source. So it wasn't that we were talking a different language, we were talking the same language, but with different meanings. So, to an economist, if you think of a kind of model with, there's an investor in A and an activity in B, then the investor is the residence country and the activity is in the source country. To a lawyer, we'd say, well, okay, how is that activity in country B organized? And it turns out there's a company formed in country B, which is legally resident in country B. So actually it's resident in country B. So we now have 2 kinds of residents. And actually the same company also has a company resident in the Cayman Islands. And if you pay interest from, say, India to the Cayman Islands, then India becomes a source country and Cayman Islands is a residence country. So we're now, very simply, we've turned the whole system into one where actually all the profits in the residence country and the residence country is the Cayman Islands. That wasn't what was intended in the 1920s. And it's, I'm exaggerating a bit how easy it is to do this. But, just for the purpose of thinking about what we mean by residence and source, it's a complete nightmare, I would say. If I seem extreme, have extreme views on how complicated the existing system is and how bad it is, then I kind of half apologize and half explain it because I've been studying these things for a long time, and the more you study it, the more crazy it seems to be. So that's what it is, and we don't have a multilateral treaty on this either. So actually, this is developed in the OECD model treaty, and there's a UN model treaty, but in the end, these are bilateral double tax treaties. So there's approximately 3,000 bilateral double tax treaties, which kind of more or less use the same framework like this, but with lots of different details in them. So it's quite complicated, let's just say the least. Okay, so given that, so actually I've given you more than 1.5 minutes. Sorry, that's I hope that's clearer though. I've given you some opinion at the same time. Okay, so okay, here's my model of multinationals. Okay, the multinationals can be in 4 different places, depending on how you think about them. There's the owners of the multinational. I'm thinking about individuals. So the residence place of the shareholders. These are all different places. There's the headquarters of the parent company. There's what I've called the affiliates, which is like where all the subsidiaries, branches, all the other bits and legal pieces that come into there. And then there's a place where they make sales. Okay, so I think those are 4 distinct kind of places. If we kind of go back to this ecosystem, we're active and passive income, residence and source. Where's residence and source in this case? Where do we actually levy most of the tax in this world? Actually, anybody, let's have a bit of audience participation at this point. Where do we actually levy most of the tax? Anybody like to shout out the answer? Where do we levy most tax in this, under the existing system? Nope. The subsidiaries, the affiliates, yeah. So there's some, okay, so you're both partly right. I'd say there's mostly where the affiliates are. There's some in the headquarters country. And actually India in particular does have a tax system where you tax a dividend payments from a third country back to India as well. So there's, in particular, there's some tax in the headquarter countries. But by residence, we're still taxing on the basis of residence. It's just that most of those affiliates are actually resident in the place where they do business because they set up companies and they're resident there, which again is, I guess I've made that point. So so that's where we are at the moment. We could think of doing other things. If we think that actually corporation tax is a proxy for individual income taxes, we should go all the way to the left-hand side there and think about taxing on the residence of the shareholders. What I'm actually going to advocate, this seems pretty hard to me, actually, if you think of multinational companies And actually you have to look through kind of portfolio investment vehicles in order to find out, I have some portfolio investments. I don't really know what companies I'm invested in, but we'd have to look through all of that so that I could, get my kind of infinitely small share of Apple profit, which I own, and it gets allocated to the UK for me to add into my total income. That's going to be hard to do. So actually what I'm going to propose is that we go to the other extreme and think about taxing in the place of sales, which is what I was advocating at the beginning. So very briefly, that's the system. Do we think it works well? I think I've given you some clues on that already as to whether I think it works well. The answer is nope. So the thing which kind of governments have been particularly concerned about is profit shifting. So estimates of how much profit is shifted and how much revenue is lost vary enormously depending on how you do your empirical work. The OECD came up with a number of 4 to 10% of revenue being lost. Just as a, thinking about that, if you think you're losing 10% of revenue, what would be the easiest way of increasing revenue by about 10%? I'd say increase the tax rate by 10% to 10%. You get, roughly you'll be able to replace it with a bit of behavioral, you lose a bit because of that. Would it be, let's kind of invest 7 years on thinking of how to design a global minimum tax? I think the answer would be probably that's not the easiest way of doing it. Okay, there's lots of evidence also on these economic distortions, and multinational companies are pretty sensitive to taxes, as they're sensitive to all kinds of things, but they are particularly sensitive to taxes because because they're sophisticated players. They have people who analyze these things who can say, actually, we don't want to go to country A because it's got an uncertain tax environment, or it's got a high tax rate, or it doesn't give any relief for research and development, which we want to do. So we're going to go to this other country. So there's lots of empirical work suggesting those economic distortions are large. I've mentioned complexity and uncertainty is just incredible. It's unbelievably complex, and it's just got unbelievably even more complex, which is kind of hard if it was unbelievable to start off with. And tax competition certainly has been a problem. Maybe less so now with the global minimum tax. The thing which I'm kind of on the fence about a bit is fairness, but that's only because I think it's quite hard to think about fairness in the context of profits of multinational companies. So there's two questions there. I think when we think about fairness between individuals, we can also think about fairness between governments, so who gets the revenue. So between individuals, what do we do when we think about fairness at any taxes? We think about incidents, who's actually worse off because of these taxes. That's pretty hard to know how to deal with that. If India has a corporation tax, how much of that tax is passed on in higher prices in India and borne by Indian consumers? How much is it passed on to Indian workers? How much is it borne by American, investors? We just don't know the answer to that. And it's probably going to vary quite substantially from market to market and product to product, depending on what the conditions of those markets are. So, is this fair? How much can we pass on to Americans? I don't know. How much is it being borne by rich people as opposed to poor people? We don't really know that much about that either. So I just think, I don't really have anything much of value to say about is it fair with respect to individuals. Is it fair with respect to which governments get the revenue? I don't have very much to say about that either. It is true. I think the kind of public policy, the idea that I have my business operating in a country and I'm benefiting from publicly provided goods and services give me some rationale to say that government should get some revenue. But then it does. It gets revenue from my sales there through GST. It gets revenue from income taxes because I employ people. There may be property taxes. So I think the question there is, do we need a tax on profits as well in addition to all of those? Maybe the answer is yes, maybe no, but I think that makes it difficult. But the other four, we're not doing well with the existing system. So next question is this a particular problem? The way that the OECD framed this problem is that everything was working quite well until the digitalized economy came along and the growth of intangible assets and the value of intangible assets is now huge. And multinational companies, they're not only intangible, they're easy to move because they don't really exist anywhere. So I could own it in country A, I could own it in country B. it's pretty easy to put it in the Cayman Islands. And then, I pay a massive royalty to the owner of that intangible asset, which happens to be a company in the Cayman Islands. That's too easy. So it's true that this is a particular problem with digitalized economies. There's a particular issue within the international tax rules which rely on physical presence. So, for example, if a multinational company is going to be liable to taxes in India, they probably need some physical presence in India. And if I'm selling cars, I probably need some physical presence. I probably need an Indian company to receive my cars from abroad and sell them. If I'm a digital company, the physical presence is less important. So it is true that these problems are important for tech, but they're also quite common in other contexts as well. This is just a kind of manifestation of the kind of basic problem of the international tax system, I would say, which is heightened in the context of tech. But we can't just have a solution which we're only going to apply to tech companies and not other companies. And that's partly because we can't identify who's tech. What is a tech company? Where do we get these kind of problems? We have a lot of digital activity by most companies now. Every retailer in the world has some kind of website presence. So that's tech. And I could buy things online from many companies around the world. So, and those companies are not kind of in tech particularly, but they're using tech. So dividing tech from anything else and having a special solution for tech doesn't really seem sensible. So what I'd like to do, I said, are we going to go back to first principles? So the first principle I want to go back to is say, okay, well, let's think of the system we've got it as I've described to you. Is that the fundamental thing we're trying to do here is to say, where do we earn profit? So let's think of a large multinational company like Apple, for example. Apple has a kind of enormous supply chain. It's got kind of activities all around the world, and it feeds through a complicated supply chain, goes in and out of countries and comes back again. There's a lot in China, but there's a lot in lots of other countries as well. Where does Apple make its profit? Well, this is the wrong question, isn't it? Surely, Apple makes profit because it does all of this at once. Apple is hugely profitable. Why is it profitable? Because it's got a massive supply chain, which is kind of optimized over time. That's part of the reason. So to identify each element of that, let's suppose there's 100 parts of that supply chain. I would say Apple is profitable because it's clever enough to have 100 parts in its supply chain, and then it sells its iPhones all over the world. Okay, so where did it make its profit? Well, it made it everywhere. I don't think I can identify, one element of that supply chain which happened to be in wherever, Bangladesh, and say that's the profit Apple made in Bangladesh. It's just like if we sat around, this afternoon and said, we're not going to choose the best international tax system. We're going to choose an international tax system which is the most complicated we could possibly imagine. What would we do? We'd say, well, let's take Apple as an example and try and figure out how much profit it makes at every individual part of its supply chain, and we'll introduce a tax system based on that. That would be crazy, wouldn't it? Why would anybody want to do that? But that is what we do. So I want to say that is the fundamental problem of the existing tax system, and none of the reforms that we've seen in the last decade or so have really come close to thinking about how to address that. With one exception, which is Pillar 1, which I'll come back to. And Pillar 1 was the bit which didn't get implemented, of course. So there we go. Okay, so I think I just want to kind of note, this is a kind of high level thinking about this. So I'm not going to get into the details of the arm's length pricing and so on. The arm's length pricing is how it's done. But, to an economist, it doesn't make a whole great deal of sense. If anybody wants to get into the details, please ask me questions afterwards. So that's where the international tax system is. So let's kind of briefly say, okay, well, where did we go then? The inclusive framework, the OECD did come up with, actually it came with 2 proposals, which were agreed, signed by 140 countries, including India, back in 2021. But actually the agreement was not that these things would be implemented. It's just that if the country chose to implement it, they would do it in the way that had been agreed. So many countries have implemented it, many have not. And the two elements of it were Pillar 1, which is to introduce some taxation of the profit in the market country. And Pillar 2 was to have a global minimum tax at 15%. So that was the idea. So there are many minimum taxes in the world, including in India. So let's just, since that's the bit that we have, let's just look at that briefly. So the key features are that we look at in each jurisdiction in which the company is operating, and we work out what its effective tax rate. And by effective tax rate, we just mean the tax liability expressed as a proportion of accounting profit, essentially. And if that's less than 15%, we take the difference between 15% and what that effective tax rate is, and that's a kind of tax rate. We apply that not to profit, but to something called excess profit, which is where the profit that we started with minus some allowance to a kind of real activity that's just taking place there. So that's the idea. That is what the minimum tax is based on. Then there's a complicated set of rules as to who gets to collect that tax. So first in order is the host country where this company is paying less than 15%. If that host country doesn't do that, then the country, the ultimate parent, can levy the same amount of tax. And if the country, the ultimate parent, chooses not to do that either, then any other country in the world which would like to levy that tax can do so. So any other country in which that multinational is operating or has some kind of presence can take a share of that tax. So the idea is, because any other country can do it, if there's American multinational with profits in the Cayman Islands is not paying any tax, America chooses not to tax it, but it's also got a presence in India, then in principle, India could tax it as well. And if India is going to tax it, that in principle is going to put pressure on the parent company, the country of the parents, to levy the tax in the first place, which in turn is going to put pressure on the source country in the first place to levy the tax. That's the idea. There's a lot of legal disputes about, actually whether that third part is actually consistent with international law or not. But that's how it's going to work. So let's just evaluate that system in terms of the criteria we have. That's not me making that noise, is it? No, okay. So now, is it going to reduce profit shifting? Well, yeah, probably will. Yeah, and that seems plausible. Now, at the margin, conditional on everything else, if I shift $1 of profits from a high tax country to a zero tax rate country at the moment, I save all of that tax in the high tax country and I pay zero. And at the margin, I'm going to shift it from the high tax country and I'll pay 15%. So the gain from profit shifting that marginal dollar is going to go down quite a lot. So we might expect profit shifting to be reduced. We might also expect reduced tax competition, certainly on rates, because actually the rates are going to go up to 15% more or less. There are lots of kind of detailed rules then about incentives. So you might have a rate of 15%, but you then may put in lots of incentives to try and attract inward investment. And some of those are kind of not allowed within the Pillar 2 rules, and others are. And there's a kind of lot of detailed debate going on about that. So it probably would reduce tax competition a bit, subject to the rules. Is it going to help with complexity and uncertainty? You've got to be kidding. What we've actually done here, we've got an international tax system which basically everybody agrees doesn't work very well. That's why 140 countries signed up to a set of alternative ways of doing it. So what would be the kind of natural thing to think about here? We have a tax system which doesn't work. Should we go back and try and figure out what's wrong with it and try and fix those things that are wrong with it? No, that's too complicated. Now, what we're going to do is invent an entire new tax called the Pillar 2 Global Minimum Tax. That's going to be completely different from the system we have at the moment. It's not going to be based on the normal way that we define tax base. It's going to be based on accounting profit. It's going to have all this kind of stuff that some of which I've already mentioned in it. So it's a completely new tax. It's pretty complex in its own right, on top of all the complexity in the existing system. And there's a whole bunch of complex things about the two systems interlinking with each other. So I've said this already, it's complex. We haven't solved that at all. And we've probably worsened economic inefficiencies as well, because actually that's related to profit shifting. Actually companies probably will pay more tax, but actually if they pay more tax, there's going to be more distortions as well. So there's a trade-off there. Or we may think that's a price worth paying. It could be, depending on how big those distortions are. But there's certainly a trade-off. So, is this better than we had before? Arguably, yeah. I mean, it could be. There's going to be less profit shifting, less tax competition. Those are the things which governments were kind of mostly worried about. But there are some costs. So, upside and downsides to that. Is it stable? So where are we with this? As I mentioned, so the global minimum tax has been introduced pretty much in the EU and other European countries like the UK. The USA, who promoted it heavily at the time, decided in the end they didn't like it after all, and they wanted to keep their existing system. So the last year or so, there's been a complex set of negotiations between countries, Europe in particular, that wanted to have it, and the USA, which didn't want to have it, and whether we could run two systems known as side by side. And in the end, the only political agreement that was possible was to allow the US to keep their own system and allow other countries to go with the kind of the OECD agreement. And there are many countries which have not adopted it yet, including India. We could come back to kind of whether it would be a good idea for India to do that or not. But for the moment, just thinking kind of globally, it's kind of, there are elements being introduced, but it's a long way from being universal. So is that stable? It's, I would say perhaps a bit more. In a way, I think, although the underlying problems remain, I think, the kind of general policy debate at the moment is already moving on to saying, but there's still problems here. There's still those underlying problems that I've kind of identified, I think, are still there. If I can have another 5 minutes just to tell you what the answer is that okay? Because it would be a shame to stop now. Okay, so this is, let's go on to what the answer is then, which is the tax in the market country. Okay, so I've already kind of said why I think this is the answer, but it's basically due to a lack of mobility of customers. So multinational companies have to sell stuff, and they have to, and ultimately it's being bought by individuals, and individuals are relatively immobile. They're not completely immobile, but on the whole, it doesn't seem likely that they're going to be particularly mobile in response to taxes being levied on the profit of multinational companies that are trying to sell them things. There would have to be kind of really quite big differences in tax rates across countries for me to say, actually, I don't want to live in the UK anymore because we've got quite a high tax rate on Apple and I want to buy an Apple Watch, so I'll move to Monaco where they don't have any taxes on Apple Watches. I might, but that's not going to be very significant. Certainly not with respect to the mobility of multinationals at the moment where they actually do their business. What about the other criteria? Is it good for economic efficiency? I would say there's kind of could be significant improvements in economic efficiency, because one of the problems we have at the moment, for example, is location distortions. So multinationals set up their factories in places where taxes rates are low. If we move to a taxes only in the market country, there would be no tax in the place where they do their production. Okay, so if everybody did it, there'd be no reason for tax to distort that location decision. And it won't matter where you do your production, because ultimately you're only going to be taxed in the country where you make your sale. And those are potentially at least two different places. So those location distortions that we have at the moment would disappear if everybody in the world adopted a taxation in the market country. Tax competition, what taxes do we not see competition across countries in? GST. So in the EU, we have lots of agreements on what we call value-added tax, which is just a VAT. We don't see any tax competition in VAT. Why not? For the same reason, because the tax is levied where the customer is. And, the UK doesn't really care what the French rate of VAT is, because there might be some movement into France. Okay, there's a little bit of cross-border shopping where, I go to France and buy all the wine because it's kind of, the taxes on wine are smaller in France than they are in the UK. So people do that a bit, but this is kind of pretty marginal compared to what we're thinking about for multinational companies. Robustness to avoidance. Here, like GST, what's the problem of GST relative to the problem of corporation tax in terms of avoidance and profit shifting? I'd say that corporation tax is, a much bigger problem. If you look at the size of tax departments in major multinational companies and advisory companies like PwC and Deloitte and the like, how many people do they have working on corporation tax? How many people do they have working on GST? I'd say they have far more working on corporation tax because there's partly because there's more complexity, but partly because they're trying to find ways around the system, and it's much easier under corporation tax. The point of a GST, is we observe transactions. We can tax transactions relatively easily compared with other things anyway. And depending on exactly how we introduce this, we can massively reduce complexity and uncertainty as well, I would argue, especially if we move towards a GST type market-based tax. Okay, but we can't tax profits where we tax sales. So in the market countries where we tax sales is not where we tax income. That could be a response. Okay, I'm anticipating that. Yeah, that's true. But GST meets my criteria much better than corporation taxes do. So why don't we just copy GST for income as well? Okay. And really, is a sales tax, this is a question for the economists, of whom you are. So is a sales tax really different from an income tax? So if I go to a shop and, buy something, I buy my Apple phone from a shop, so there's a sales tax on that. Well, on the one hand, I'm making a purchase, that's an expenditure. On the other hand, somebody's selling me something, that's income, isn't it? If I sell something to one of you, my income goes up, your expenditure goes up. So why do we think of, one kind of tax as a sales tax and one kind of tax as an income tax? In fact, the whole distinction between direct and indirect taxes, we should debate. Is it really the case that we could think of these two things separately? In a purely domestic setting, even more so. Yeah, you're going to argue about this. Let's, okay. Okay, so you're talking about the formal instance or the effective instance? Because the formal instance is probably on the seller anyway. We think of it as being a tax on my spending, but actually I don't remit any money to the tax authority. That's remitted by the shop or the person I'm selling from. Because, for good reasons, because administratively it's much simpler to do that. So, okay, so we've got this shop remitting the tax. Okay, the effective instance says, well, who's worse off? Let's draw a simple supply and demand analysis. Say, okay, we've now put a tax on the supplier. What's going to happen to prices? There's a fundamental theorem of public finance which says it doesn't matter whether you're going to tax the shop or the seller or the buyer. You're going to get the same economic effects. So that is the instance of that particular tax would be the same whether it's on one side or the other. And then, whether we call it a sales tax or an income tax, it seems odd to call it a sales tax when actually what we're doing is we're selling, this is a tax on the income of the shop, isn't it? The shop has sold me something, they've got some income, we're taxing it. They're remitting the money to the tax authority. Why do we want to treat that differently from, why do we want to think about that in a completely different way? I'd say we should kind of start questioning that. So I can see other questions coming up. I'm going to move on and let's debate that later, possibly over dinner, but because that's quite a big question. So I thought I'd throw that in there to be provocative. So at least that's a success. I could tick that one off. So, okay, but we could think, so here's another reason why actually they're not so different. So if you take the GST tax base, if I understand this correctly, is basically the same as the VAT that we have in the UK. Now, this is kind of sales minus the cost of sales. That's value added, basically, in accounting terms. Okay, so, sales minus the cost of sales in the absence of any taxes or financing, that goes to shareholders and it goes to employees. It goes to shareholders in the form of profit. It goes to employees in the form of wages. So, yes, okay. Yeah. Can I come back to that? Okay. We're in danger of getting sidetracked on capital gains taxes. which, okay, let's come back. Can we just come back? Let me finish this point and then we come back to it. Okay. So the point I'm trying to make here is actually, if you take the GST tax base and say, actually, we're going to give relief for wages as well, wage payments by the company. Actually, you've got a measure of profit. In fact, you've got a measure of economic rent. So if you wanted to tax economic rent on a destination basis, you take the GST and take off wage payments, and what you've got, yes.
GST is based on domestic consumption, whereas income tax is on global income. You
Yeah.
zero rate the GST. You don't do that with regard to income.
If you zero rate the GST,
Yeah.
okay. So that's a fair point. Okay, by GST, let me rename that. I'm thinking of a pure VAT, a pure GST, where everything is taxed at the same rate. Yeah, that's yeah. Yeah, quite. What I want to think about is how can we have a destination-based corporation tax? And so, a good starting point is, well, we have one destination-based tax. We don't, no. But I'm advocating it. I would like to advocate it. In particular, what the key thing which makes the GST on a destination base rather than kind of some other base, source base, is the border adjustment. So we don't tax exports, but we do tax imports. So imagine a corporation tax where we don't tax exports, but we do tax imports. That border adjustment would effectively say, okay, you're producing here in India, but you're exporting, so we're not going to tax it. However, if something produced in another country exported to India, we are going to tax that. That's what we do with GST. So that's my comparison with GST is basically saying, let's take that border adjustment and think about applying it to corporation taxes. Maybe making a few other adjustments along the way as well. But that would turn it into a destination-based tax. That's the point I'm trying to make. We could debate whether it's a good idea or not, but that would be... So you could actually have a destination-based tax on profit actually by taking the GST, make it into a perfect GST at single rate on all goods and services, giving a relief for wage payments. And I would say that's what I would call a destination-based cash flow tax. It's a tax on economic rent on a destination basis. So, okay, that's my solution. Let's debate that now. And just kind of the last point is, is this just a kind of academic pie in the sky? Is there any ever chance of moving towards this solution? So I've got three possible scenarios here. One is we all go to the OECD or the UN and debate it, and everybody gets persuaded by people like me, and the world tax system gets changed on a multilateral agreement. Yeah, that's pretty unlikely. I concede that. Okay, number two says actually, although this is globally beneficial, it's also beneficial for countries which do this. So this nationally beneficial as well. If you replace a source-based tax with a destination-based tax, you're basically saying to multinational companies who are thinking of coming and investing in your country, fine, you want to invest in India, but you're going to have lots of sales abroad. We're not going to tax you. No, we do tax you at the moment, but we're not going to tax you then. Of course, if you kind of invest in Australia and export to India, we will tax you, but that's tough. India's got a massive market. There's 1 billion people here. If you want to sell to that 1 billion people, you're going to have to pay tax. That's akin to kind of Trump tariffs in a way, but it's in a kind of context of a better thought out system. So that's possible. And, actually the US has thought seriously about this. There were hearings in Congress only a few weeks ago about thinking about this. And, the US obviously thinking about it from their own perspective. And on the third option is actually corporation taxes wither. And I think, I thought this was more likely 3 or 4 years ago before the global minimum tax was introduced and the tax competition was driving down corporation tax rates. I think it's quite likely they would continue to going down and withering still further. I think that's more questionable now because there's this kind of 15% global minimum tax, except it's not global. It's a 15% minimum tax in some of the globe. If that happened, then countries would have to rely on other systems, and GST is the obvious system to rely more heavily on, and that would actually if we thought about that in the context of taxes on wages, then that would actually be moving in the direction which I would be advocating as more sensible. Let me stop there, and we can have further discussion. Thank you.
Thank you very much. Thank you very much, Mike. And I must admit that this is the most easiest way of presenting the international tax system that I could ever heard of. That's apart that I have a question, but I'm not taking the freedom of being the chairing the session. So I know that there are lots of questions from Mike's presentation. So I will request all of you to make very short and sweet question, so that it would be very sweetest way of presenting international taxation. Thank you. Please.
I hope short questions. I'm going to persist with the profits point, Fabi. So if you have a company that makes profits but has a very small payroll, then would your analogy hold true? For example, a finance company. I have 3 employees on my payroll, and I make a lot of money on investment income because I'm in the business of essentially moving money about, and I make profits out of that. Then would that equation hold even roughly? I ask this because that then really impacts countries with a large financial sector, including surprisingly India. My first question. My second is a case. This is more clarificatory, and this is interesting because of the broader questions, non-tax questions that arise when you frame a system. Let's take my favorite bugbear. So you have this German company, yeah? They like to make batteries because Europe loves green, right? Now those batteries require lithium, and the lithium is produced in the Congo. So they go and buy the lithium, input, bring the lithium to Germany, make the battery in Germany, and sell it in Germany. Would your market-based taxation system then not be unfair to the Congo? I mean, the Congo doesn't get a say here in the taxes that are being produced through extraction. And extraction has been a major source of profit, right, from the East India Company down to the Germans in the Congo now. So your views on that? Thanks.
On the second question, yeah, I mean, I didn't have time to explain my kind of full plan, but I would actually also have a tax on extractives. So I would say, okay, if Congo has got lithium and people want to buy it, they should be taxing that because it's in Congo and they own it, and definitely. So I'd do that as well as a tax, and then Germany can tax sales as well if they want. Yeah, so I agree with that. That's a good point. Financial companies, if you've got no wages, then it's all profit. So tax away. Yeah, what's the problem? Okay, that's short and sweet. Okay. Okay, next.
Can I?
Yeah.
No, I didn't get the last part of your listing. Are you suggesting that, the GST can substitute all other taxes? Because there is one of the papers, Alan Auerbach, basically makes this point that you make it a destination-based GST. It takes care of everything else. But then when, in fact, in one of the papers, when I made this review, in fact, Alan told me later that it's okay, but except for taxing natural resources. Because in the case of natural resources, obviously, it's not possible to do that. No, I'm asking that question for that reason. Are you trying, but if you do that, if you try to make corporation tax also a sort of a destination-based tax, then you encounter the problem of tax shifting, with the low tax jurisdictions. Obviously, whichever way. That's one question. The second question is, I want, so the whole issue of profit shifting and tax efficiency that we talk about will also depend upon the trade agreements. Now, you haven't touched upon that particular issue, and what is it that you want to, do you want to say anything about that?
Okay, in my defense, I was only given 45 minutes. And
No, no.
yeah.
No, I'm
Right, okay.
no, I'm not, I'm not charging you.
Yeah,
accusing
sure.
you of anything.
So
I'm just trying to
Yeah.
learn, understand.
yeah.
Yeah.
And I exceeded 45 minutes. So yeah. So I'm not really, my point was not to advocate GSTs. My point was to think about a way of a better way of taxing profit. And the key element of a GST for that purpose is this border adjustment. We don't tax exports, we do tax imports. There's another element of GSTs, which I think is very helpful as well, which is it's like a cash flow tax, like a cash flow corporation tax. So we know that a cash flow corporation tax just taxes economic rent. So a different way of thinking about it is start with a cash flow corporation tax, which just taxes economic rent. That's a good thing because we like taxing just rent because it's less distortionary. And then we add in the border adjustment. And then, so that I think the problem with a cash flow corporation tax on a kind of the general source base is, even if you have two countries, if all countries have got cash flow taxes, there's economic rents we're just taxing economic rents. But country A has got a 30% tax rate, country B has got a 20% tax rate. We still get a distortion to location decisions. So that's the kind of problem with a kind of typical cash flow tax, of which we don't see many, but well, actually, maybe we see increasingly that quite a lot of countries have got, 100% depreciation allowances for many assets. So the point of the border adjustment then says, okay, we're not going to tax you anymore in the place you do your production. We're going to do it in the place where you make your sales. And then we take away that location distortion because you're not being taxed in that place. That's the idea. So my link with GST is just to say, well, look, this GST work has two elements that we like. One is that it's a cash flow tax, which gets us to economic rent if we also take away wages. And we have a border adjustment, which takes away the location choice. So that's where I'm going. And I have to say, I agree with Alan on this. Alan was part of this group of economists and lawyers, which I mentioned, and I've written papers on this with Alan. So I'm on the same page as Alan there. Profit shifting to low tax jurisdictions in the context of the tax I've just described, I think is really hard. Do we see the tax base for GST being shifted to the Cayman Islands? I think we don't, because it can't be done. At least it can't be done very easily. It's not at all like corporation tax. Corporation tax says, okay, I own my intangible assets in the Cayman Islands. You pay me a big license fee from India to the Cayman Islands. You get a big deduction in India. There's a big tax charge. There's a big taxable profit in the Cayman Islands, but there's no tax rate, so I don't pay any tax. That doesn't apply with GST. So I think it's actually, I've written papers on how easy is it to shift profit in this kind of context as well. And I think it's actually really quite difficult. You certainly can't use the same techniques as we use and know and love in the corporation tax system to shift it if it's based on a cash flow tax and the kind of GST type border adjustment. It's, you might think of some ways of doing that. And that's actually to expand on that a bit, I think there are other ways of actually introducing a destination-based corporation tax, which don't rely on the GST border adjustment, which are like a formula apportionment system. So the OECD formula apportionment system said, okay, you take your worldwide profits, and then we allocate that to individual countries on the basis of their share of your worldwide sales. So if you've got 15% of your sales in India, you get 15% of the profits and you tax that. Now, that's a very similar kind of idea, but actually it's a bit more tricky to implement. You have to kind of identify where those profits are. You have to think, well, actually, turns out I made all my sales to an independent agent in the Cayman Islands. So actually my worldwide sales were all to this one guy in the Cayman Islands. So actually I don't pay any tax. And I made huge profits, but they're in the Cayman Islands, I don't have to tax it. The guy in the Cayman Islands who bought it from me then sells it on to India. So he would be paying tax in India, but he doesn't make any profit. And so, there's not going to be very much tax there. So I think there are ways of manipulating that. So I think that the idea of, the destination-based tax is nice in principle. I think you do have to think hard about how you're going to implement it in practice, especially for things like, is it easy to shift profits? Trade agreements, I'm not quite sure where you're going on trade agreements. Do you want to talk more about those?
No,
Okay, we could talk about
no,
this later.
what happens is that, if there are trade agreements, then profit shifting becomes much, sort of identification of profit shifting becomes much more difficult.
Okay,
And then determining the tax base itself becomes difficult. We have, for example, recently we have had a case of Mauritius case.
His model that entire thing doesn't exist because you are only you're effectively taxing transactions. Taxing
transactions.
transactions.
Okay,
You are drilling it down to taxing of transactions. So therefore,
No, but then if you're talking about corporation tax,
yeah,
it's a corporate profit tax, isn't it?
yeah, it's a proxy to corporate.
it's like a corporation tax in some ways, but not others. In fact, there's a kind of interesting issue of if you did do this, what the GST kind of route, whether this would be a tax on income with respect to double tax treaters or not. So, which is another interesting question. And if it is, that makes life much more difficult. So it's kind of, in some ways, it's better not to be and get outside of that system.
I have two small ones. The first one, extending or reiterating back to what Rathin said on capital gains. Is there an idea of how capital gains get treated?
Yeah.
And secondly, what happens if you're undervaluing your exports, overvaluing your exports, and that is a tool for transferring monies from one jurisdiction to the other, which is a standard form of
So again, it depends how you do it. So if you do it the GST kind of route, then I suppose you got a company in India which imports and kind of buys from me in the UK and then sells onto an Indian customer. The price at which it declares that, suppose it's actually buying from another part of the same group, so that it can manipulate the price. But the price, you pay tax on the import when it comes in, but then you get tax relief against that when you make the sale to the final consumer. So it actually nets out.
no, but look at it from the export leg of the
Yeah.
It is easy to transfer money resources outside by overvaluing your exports. You pay less taxes.
Right. So okay. So you suppose you got So ultimately, you're going to pay tax depending on the sale to a final consumer. So you're not going to pay tax in the country where you're exporting it from because it will be zero rated.
No, so there's an issue of valuation risk
Yeah.
in the exporting country.
Yeah, but you're not taxing it anyway, so that doesn't matter. I mean, this is like I'm into GST.
Company is choosing to export and sell domestically. You're trying to decide how much of its value is sold domestically and how much is exported. I can overvalue my exports, undervalue my domestic consumption, and so I pay less tax than this.
Well, the amount of tax you pay on your exports will, you're thinking of kind of selling it to a third party, you're thinking of selling it to kind of another subsidiary of the same company in a different country.
Subsidiary, same company. With
Okay. Right. So the tax you pay on your exports is ultimately going to depend on where you export it to and the tax rate in that country. Okay. So you're not.
Reshifting.
Okay. Let me think about that. Okay. So you're thinking. So okay. So I've got a company like in country A with a tax rate of 15%. I'm exporting to a country with a tax rate of 25%. And you're saying, okay, my choice of whether to export or not will depend on those two tax rates.
Choice of the price at which I export. It depends on the two taxes. So if you
I'm not. Yeah.
Of goods.
Yeah.
So just 50, and the rest are sort of transactions which take place in other jurisdictions. So you undervalue them in low tax jurisdiction. And so in a sense, it goes back to.
Yeah. But I don't think you can't, I mean, you might be manipulating the sale domestically. Is that what you mean? Because you can't manipulate the sale when you know, ultimately you've got to sell it to somebody. You're selling it to a third party ultimately. So, you know, that's hard to manipulate, isn't it? Because you've got a third party who's willing to buy it from you.
A body of international literature which is looking at just this question of valuation of it.
There's another problem.
Yeah.
But I think there's another problem would be in this case. Suppose if I undervalue my export and my input tax credit corresponding, I have to forego because I am zero rating the exports.
Correct.
So
But you need to input tax credit.
no,
Whatever input.
you are saying the price will be reduced and the value of that could be one issue because the transfer pricing even in the GST case
Yeah.
is very much valid.
Is what there is.
Yeah.
Transfer pricing.
I mean, yeah.
Pricing is also one issue that we have to think about and
Well, okay, maybe we should come back. I mean, I'm not convinced.
maybe
That's-
tomorrow morning.
Yeah. I mean, there's, okay.
So
We need
so
to
we have any other question?
Yeah. Okay.
Otherwise, I have a question. The thing
Yeah,
is
okay.
that what I understand is that the rules of the game
Yeah.
in international tax is not fixed yet. So is evolving.
Yeah.
So, and the evolution of these rules is very much political.
Yeah.
And is against of developing countries.
That's not
Is
so
bad.
obvious to me, actually, although I mean, it's a common claim. Yeah.
Because if it is not the benefit of few countries, big countries, then they are not going to accept that thing. So the problem that even finance minister talked today was the political economy approach of entire architecture of tax, international taxation.
Yeah.
And how do you see that it will benefit the developing country like large open economy like India? And the presence of India in the global presence of India is growing up. So how we are going to benefit from international taxation?
From this reform, you mean, or generally?
Yeah,
From
how?
this reform.
Yeah, from this reform and also evolution that is not in favor of India always.
I agree that the existing forums that we have for thinking about international tax are not set up for the benefit of middle income countries. You know, they are set up by the rich countries, and I'm not sure they have much interest in helping anybody else. I agree with that. I think there's quite often a kind of case made, say, that actually, and this is a kind of I think this is partly a confusion of the terms residence and source again. We think of the kind of rich countries as being residents, and and developing countries as being source, and it's all too heavily favoured in favour of residence countries. Actually, I honestly think of the Cayman Islands as being a resident country for most of these purposes. I mean, people don't shift profits from India to the UK. Why would they? They would shift profits from India to the Cayman Islands, and that doesn't help the UK. And actually, they shift profits from the UK to the Cayman Islands as well. So I think there is a kind of reasonable set of questions to ask about, to what extent is the agreement favouring, richer countries or poorer countries? I think that is true. In terms of the kind of proposal I'm making, actually, I think this would benefit India. Although, it's not my role to advocate things for India particularly, but India has got a massive, market. There's a lot of people here. They spend a lot of money, and that's not going to go away. So, if you like, the GST is based on that market. So corporation tax is not based on that market. Corporation tax is essentially based on attracting companies to do productive things. And if there are kind of more advantageous places for them to do those productive things, then they will go to other places. So, actually saying we're not going to tax that productive activity, we're only going to tax you when you make a sale here, should be beneficial. And even if India was the only country in the world to do this, and there was at least no retaliation, which could be a possibility, but if they did, I think that would be beneficial for India. Yeah.
Thank you very much, Mike, for
Okay.
your excellent interaction with participants of this program.